Thank you. Is the mic working? Yes, it is. Good. The most popular method for funding a blockchain project historically has been to use an ICO, or more recently an IEO, or in parallel, a more structured, more regulated STO approach. Now, common across all these is the majority of the funds are actually raised in cryptocurrency. Now, for a company or a project operating in that space, that has a number of benefits, but it also has some significant unique risks associated with it. Cryptocurrency, just like any new asset class, is characterized by quite extreme volatility. It's not unusual for a market to move up or down by 30% with very little news. You just need to look at Bitcoin over the past 18 months. Up to 20,000, down to 3.5, now back up to 11,000. So it's a very volatile asset class to be trading in. Sorry, I'm going to get back on top of my slides. The typical approach followed by most projects is to hold the funds in crypto and hope for the best. Now, that works until it stops working, and then they typically move into fiat, and they typically do that at the worst possible time, at the low of the cycle. So it's not really an ideal approach. What I want to talk about today is alternatives to that. Volatility isn't common to just the cryptocurrency industry. There are other industries that need to deal with similar problems. What I want to look at is the way they tackle it and how that can be brought into the crypto industry and used as a method for token founders and their teams to really manage the risk and maybe generate excess returns on the assets under their control. So before I got involved in the crypto space, I had a 20-year background in financial and commodity markets. I was responsible for optimizing the hedge activity for one of the largest commodity trading companies in the world. The thing that convinced me to make the leap into the crypto space was the similarity between the two industries and the opportunities that they offer. In both industries, the asset that you hold, while volatile, it also provides tremendous opportunity for profit if it's managed correctly. And yet, whenever I speak to ICO teams, they rarely consider how they can use that to benefit their project. I want to look at the behavior of most ICO teams during late 2017 and early 2018. During 2017, there was record inflows of funds into ICO projects. We saw Bitcoin go from $1,000 up to $20,000, and most people in the industry thought that trajectory was going to continue. Most of the projects didn't give a second thought to how they were going to protect the assets under their control. We know how that worked out. Within a year, Bitcoin had fallen by 70%, and along with it, the fortunes of a lot of those ICO projects. This raised a number of questions for the ICO founders. What was the value of the assets they had left? Was it enough to fund their project? And what should they now do? Should they leave it in crypto, or should they move it into fiat currency? At best, most of those project teams found it took too much of their time. They were no longer able to focus on the project they intended to deliver. And for some of them, they just had insufficient funds. They couldn't move forward. Even the ones that did continue, what we found is a lot of them just moved the money into fiat at the wrong time, just before this year's rally started. So it's a really difficult problem for a lot of these teams to manage. As I mentioned earlier, commodity companies are faced with the same problem. They have a highly volatile asset that's central to their business operations, and also is a major asset that they hold. What is it that they do that's different, that sets them apart from crypto companies? So I'm going to use copper trading as an example. If you imagine a copper trading book, you typically break that into three components. You've got the immediate inventory, the active hedge inventory, and long-term inventory. The immediate inventory is copper that needs to be delivered over the next 3 to 4 months. And that's always hedged in the market. The risk is covered. The active hedge inventory is the majority of the book. That's copper that's going to be delivered the next 3 months to 3 years. That element's actively traded. And then the long-term inventory delivery over 3 years, that's a more passive hedge and is rebalanced on a regular basis. Now, for crypto companies, the commodity's different, but the approach should be similar. So immediate inventory, that's the operating cost for the projects over the next 3 to 4 months. That should always be hedged and swept into either fiat currency or a stable coin. 75% of the remaining crypto assets can be used for active trading, either by an in-house team who are focused on that, or by an outsourced specialist. Either way, it should be automated. What you don't want is the management team of the project focused on the market and what's happening and not focusing on project delivery. And then you've got the passive hedge. This is 25% remaining, and that should be in a balanced portfolio and rebalanced on a regular basis. To illustrate the benefits, there was an ICO that we managed the assets over the bear market period. In August 2017, they raised $2.9 million. We started trading the assets in September 2017, and through to May 2019, we generated an additional $3.6 million of revenue for that company. That extra revenue allowed them not just to survive through the 2018 bear market, but they actually were able to grow and thrive. And they've reached the point now that they're actually able to distribute a lot of that excess profit back to token holders in the form of airdrops. So it's something that is really worth spending time looking at and seeing how you can do it well for the project that you work with. Sorry about that. I've talked so far about ICOs that are in operation. Also want to look at ICOs that are just launching, that are setting up. In 2017, capital was very easy to raise. You had a good idea, you had a white paper, you could raise the capital you needed. 2019 is very, very different. Investors are looking for well-structured plans. They're looking for good management teams, and they're looking to understand how you're going to manage the risks associated with delivering your project. And part of those risks are obviously what happens to the crypto assets that you're custodian of. As an illustration, part of our group, we've also got an ICO investment fund. We invest in ICOs and STOs globally. Now, on top of how good the management team is, how good the project is, we look at 3 key attributes. What's the 18-month operating budget for that company? What's the custodian relationship that they're using for the crypto assets? And how are they managing the risk on those assets during the lifetime of their project? We've seen that on top of the project viability, these are critical elements to a project being successful in the long run. And it's got to the point we actually won't invest unless we're satisfied that those 3 elements have been thought through and understood by the management team. The last thing I'm going to discuss is we've talked about the value of risk management for launching an ICO, for running an ICO. But there's also an element shortly after an ICO starts its operational phase where it's really subject to a lot of reputational risk. Up until the close of the funding phase, there's a lot of communication from the ICO. They're talking to the community, they're trying to get the community comfortable with their project. After that's finished, there's often a drop in that level of communication. And it's kind of natural that happens, because the project team are focused on delivering the project they've set out to do and hitting their milestones. The problem you have is the token community have become very comfortable with regular communication with the token founders, with regular updates on what's happening, and they're anticipating delivery of those first milestones. Now that's a really dangerous period for most ICOs. If the token management aren't giving out information, then the community will come up with their own information. Small problems can very easily escalate into major issues, and if it's not managed carefully, then the token's long-term reputation can be seriously damaged. Now, we believe that by being very open to the community in terms of the assets raised, the assets held, how they're held, it creates a bridge for that first period before the milestones are delivered. It allows the token community to be aligned with the management and understand what's happening, and it helps to stop that dissatisfaction building up in the first place. So I wanted to just give an overview in this presentation. Why is risk management of the assets so important, and how it can be a benefit to most ICOs out there, and the way they manage the funds. Now, I run the hedge fund side of Panzora, so our team are responsible for working with ICOs, seeing how they want to run, putting together a strategy to help them manage the risk and also generate excess returns where appropriate. As I mentioned earlier, we also have an investment fund. So if either of those are of interest, I'll be happy to speak to you over at our stand in the exhibition area later in the show. But I'll wrap it up there, and thank you very much for your time, and I hope you enjoy the rest of the show. Thank you.